In this week's update, why technical analysis in context always wins. Is the character of the US market shifting and the complex dynamics around gold? My name's Garry Davis and I'm an authorised representative of Primary Securities, and the information presented here is general information only. All right, look, a fascinating couple of weeks, so lots to unpack, but the main theme that I want to address is the importance of using charts very much to advantage and prioritising that as your primary decision-making mechanism in the market, because the last couple of weeks have certainly shown that fundamental logic and the reaction of the herd is not where you want to be. So if we look at Trump policy, it's just another week of unpredictable, sudden things that really, there were a couple of stunners in there. I don't think anyone saw a takeover of Gaza coming, except if you were in the Trump war room. The potential for a US sovereign wealth fund, no idea how that would play out, but it can't be a negative thing for markets. The possibility of owning part of TikTok as well. I mean, these are all things that I don't think anyone in their wildest dreams would have predicted. And of course, underpinning all this is what would appear to be the basic strategy of Trump, and that's to be using tariffs as part of a leveraging tool to foster domestic manufacturing. So make America great again, get manufacturing back home and really get the US economy roaring. And he's certainly pressing all the right buttons to do that. Whether the establishment allows him to achieve it or not remains to be seen. And it won't be an easy road, and the market will react, I'm sure, in both directions at various times. So absolutely nothing has changed that would suggest that 2025 is not going to be a pretty volatile year. The possibility of more rate cuts from the Fed is still up in the air. The jobs report on Friday night was mixed. It could be interpreted either way. But as a big picture backdrop, we've got the ECB, the Bank of Canada, and the Bank of England, all with very recent rate cuts. So the trend is definitely down, and the Fed is more likely to cut rates than to raise rates. Let's put it that way. Rates may remain the same, but the trend is down, and the likelihood that the data is pointing to is that rates are going to be cut. And that's going to be a positive for the market. But look, it's the tariff impacts and what they could do to global growth, what they do to currencies, all those things factor into it. So it really makes discussion of rate cuts or rate hikes pretty worthless, I think, because it's just so unpredictable. So don't get caught in the position of trying to figure out what all this means and then take action accordingly. I think you're wasting your time. In fact, worse than wasting your time, because if you try to figure this out in advance, you plant an idea in your mind that colours your thinking. You know, if you reach a conclusion that certain things are going to happen, then you've got to overcome that with more factual evidence. So I think it's actually a bad thing to try and sort out what all this means. Just keep an open mind and remain flexible. Now, US earnings season is well and truly in full swing. It was a big week. We've got another huge week of stocks, some 400 or 500 US stocks reporting in the week coming. But so far, you'd have to say that it's a season of strength. Now, there's been some mixed results and some poor market reactions, admittedly, but they've been the minority. And if you do something like, if you're interested in this, just get a hold of something that allows you to do a 52-week high scan and just have a look at the types of stocks, the market cap, the sectors they come from, just to give yourself an appreciation of how broad this rotation is now becoming. The breadth of stocks setting new 52-week highs is really quite awesome. So that's a really good sign, because some of the Magnificent Seven and some of the other mega cap stocks have not reported to the market's liking and have been marked down. And stocks like Microsoft and Google, for instance, have been hit sharply. So this broadening of the market is a very, very good thing for the health of the market. Now, I want to just deal with some realities, because the last couple of weeks, the 2 Mondays, the DeepSeek moment, and then the tariff imposition on Mexico and Canada have really brought home the advantage, the necessity to look at things in context and be guided very much by what the money flows are doing, not what you think they should do. So here's some market realities that hopefully will be helpful. Prices rise because analysts, major players make assumptions about the future, and they're based on their perceptions. Now, yeah, sure, they're based on data, but at the end of the day, there are a whole bunch of assumptions in there. Prices do not rise because of today's facts. So just because a company has done well in the last 12 months, it does not impact necessarily what the market price is or what the market is expecting in the next 12 months. So it's not today's factual evidence. And on top of that, assumptions are constantly being revised as well. So that means that this is not a set in stone situation. It's a moving feast and it's constant. And sometimes it's very, very sharp. So where the money is going, what the big players are actually doing with their money is far more relevant than where the facts indicate that the money should go. And it also changes quite rapidly. So fundamental analysis, from my perspective, is a tool to get you in the most probable ballpark and nothing more. It's a tool to allow you to uncover the stocks that not only have performed well, but have got all elements that would make them probable to perform really well in the future. It's not a guarantee. It's just about probabilities. So fundamental analysis is not what moves prices, because it's all based on shifting sands. It's all based on assumptions that are changing. So fundamental analysis is just a tool to get you in the probable ballpark. And I think the sooner that you embrace that market reality, then the better the investing results that you're going to get. Things like, people say to me, I like this stock for the long term. I'm just going to sit on it for the next 5 years. Well, market reality is I don't care. I don't care what you think. I don't care whether your analysis is valid or not. It just doesn't matter, because the environment is going to change anyway. Another one that I get is, particularly with more speculative stocks, people viewing this video might be able to identify with this. This stock looks like an absolute brainer. This technology is absolutely fantastic. This is going to be a 10-bagger, 20-bagger. It's going to the moon. Lots of new entrants to the market get very, very excited about new technologies. Well, again, the market doesn't care because it's looking at other things. And there's a huge difference between a new technology and commercialization of that new technology. They're two very different things. And I've been running a service called Portfolio Analyst since 2018. It's partly a question and answer service. And during that time, I've been asked about easily a couple of hundred new technology stocks that when you first look at them, they look absolutely fantastic. They look absolute no-brainers. And you would expect that just given a few years, they would be enormously successful. I haven't done a mathematical study on this, but my gut feel is that at least 80 to 90% of those seemingly fabulous opportunities 5 years on have not materialized. In fact, the share price has probably gone down by a great deal. And the investors that got very excited about that technology and decided that it was a no-brainer and they would just sit on it for the next 5 years and it would just have to come good, have lost most of their money. It's another market reality. So you just don't want to get caught assuming that something that looks and smells really good is going to work out that way. And it explains why the best of the best stocks over long periods of time, and I'm talking about stocks like in Australia, PME, REA Group, XRO, WiseTech Global, those sort of stocks that have just done fabulously well over a decade or more, and there's any number of them in America, why the best of the best do what they do. Why do the prices keep going up? These stocks are super expensive, seemingly on the surface ridiculously expensive. Why does the price keep going up? And it's about the perception of probability. When the market really believes, and the company justifies it year after year with meeting those expectations, but when the market perceives that the probability is really, really high, then it is quite happy to award a significant premium and to do it year after year after year. Now, it's only on rare occasions that that is warranted, but mostly it's not. Most stocks that look really good at some point stumble. So you've got to be incredibly selective in what you're looking at. There is a far better approach, which is built more around technical analysis than around fundamental analysis, and it avoids the lost opportunity cost. Because if you get locked into a stock for the long term that doesn't perform, or even worse, goes down, then not only have you lost some money, but you've also lost the opportunity to get into some of the great stocks. Now, I just want to take a look at the market dynamics around the last couple of Mondays. So go back to January 27 and let's call it the deep sea panic. In the tech world, a lot of people were saying instantly within the first 6 to 12 hours that the tech world as we know it, just dissolved and things were going to change. The hyperscalers, their business models were now redundant and all sorts of terrible things were going to happen. So there was a big market panic and stocks got absolutely smashed, particularly a lot of the stocks that had gone up, the picks and shovels providers to the AI revolution. But it just didn't feel right. And the importance of context when cooler heads prevailed and really thought about the situation just showed that making sure that you put these things into context is really important, and assessing the probabilities. We'll take a look at one of those in just a minute. But the question I'd pose to everybody is, what did you do, or what did you almost do when you got up on the Tuesday morning and saw what the American market had done on the Monday night and how our market was going to open? Did you panic? Did you sell? Did you have your finger on the button? Were you going to be enticed into panic selling along with everybody else? And then, of course, not very long, only a handful of hours after our market opened on the 28th, did money flows indicate that this wasn't as serious as the initial panic warranted. Then a week later, we get, again, a week starting in panic situation. And there was a big panic around the imposition of tariffs. Now, the market had known that this was going to be Trump policy throughout 2024, well before the US election. So why the big panic? I would have thought that no tariffs would have been the surprise to the market, not the fact that tariffs were there. So again, a leveraged market overreacting grossly to something that had been well and truly known and flushed out. So let me just go and do a couple of those charts. So I'm just going to show one example. It's a US example, and that's all it is. It's just an example. But the lesson here is the money flows and putting this event into context. And this is just one of hundreds of stocks in America that behaved like this. Now, 6 of the 11 sectors actually went up. So this wasn't a general market-wide panic, but it was certainly a panic in the technology sector. So most of these stocks, these hundreds, were found in the technology sector. In this case, this is a stock that had been rising very, very nicely. And on January 27, let's call it the deep sea day, the stock ended up being down 28% from where it had previously closed in one session. So a stock that had been trending very, very strongly, down 28%. And then 7 sessions later, at the peak up here on February 5, it's trading up 64%. Now, if you had overreacted and jumped on the bandwagon with everybody else and panic sold this stock or hundreds of others, or done the same thing in the Australian market on Tuesday morning, without the benefit of looking at the context, looking at the probabilities, and just being a bit calm and collected about this, then that's made an enormous difference to the value of your stock portfolio by overreacting to those sort of situations. So the important thing here, and this is where technical analysis is so vital in pointing out where the money is actually going, this didn't make a lot of sense when looked at coolly in context. So just give it a couple of days to see what the market is going to show. Now, this stock had the advantage of also reporting some terrific earnings. I think it was on January 30. So that certainly helped. But this was a price that was always going to rebound. And the evidence of that was not in the fundamentals. The evidence of that was in the chart and being able to read the chart in the right sort of context. So very important to be able to do that. And this all gets to the heart of what these Sunday videos are about. And that is that it's just so easy if you just follow the market with only a small amount of knowledge or experience. It is so easy to lose money in the market, and hence the requirement to have a plan and to have all the resources around you that allow you to look at things in the proper context. Let's look at the American market now. Some late selling on Friday pulled a positive week just into the negative. The S&P was down 0.25%. The Nasdaq managed to finish roughly flat. The Russell 2000 was down 0.2%. But going back to something I said earlier, and that is if you, just for the purpose of the exercise, have a look at the 52-week highs and just have a look at how many stocks, particularly of the smaller variety, are setting new 52-week highs in America. And some of the trends and breakouts are just staggeringly powerful. They're not just creeping up, they're gapping up, rising at very, very strong trend rates. So this is a market that's very much stock specific. There was some late selling on Friday. The jobs report was certainly open to interpretation. I read it and my first thought was, that's good. And then I read it again and I thought, well, that might be taken the other way. So I was quite unclear as to what the jobs report actually meant for the markets. So it's a tough one for the Fed in deciding interest rates. And the direction of interest rates, of course, is a major contributor to where the US market is going. And for those Australian-only investors, where the US market is going matters. It really matters for our market because it sets the tone. Q4 is broadening, certainly beyond the tech sector. We're seeing both in the earnings and in the charts, there's a clear rotation into small caps, which is very exciting because some of them are coming from fundamental positions of being really very cheap compared to their growth rates. So I think this has the potential to have plenty of legs. The US dollar was a little bit lower, but there was very large volatility, and that really underscores the uncertainty that the market is facing. The 10-year yield fractionally lower, 4.5, and the VIX was pretty steady around 16.5. So let's, for the purpose of the exercise, let's go and look at the US indices, but they really are not telling much of a story, to be honest. I'm showing them just for the record. So this is the S&P on a weekly chart. You can see it was trading up quite nicely until the last 3 or 4 hours when the jobs report pulled that down. If we look at the Russell, not much change there. Again, it was trading up quite comfortably until that jobs report hit. The Nasdaq managed to make a very small gain. Now, I just want to look at the relative money flows and where they're going. Now, these are the US sectors since the first rate cut back in September. So the leaders, consumer discretionary, which is interesting, communication services. Then we've got technology and finance. Finance has done very well since the outcome of the US election was known. Energy has been a complete roller coaster. And of course, at the bottom is consumer staples, which is very revealing. This is definitely not a market that is in any sort of defensive mode. And also healthcare at the bottom. So that's how the US market looks. If we look at Australia, over the last quarter, information technology has done quite well. Finance has also done quite well, which is a complete mystery to me, but I'll leave that for this week. Small caps also doing well in Australia. And then we've got energy and healthcare and materials, whilst it has improved since the start of January, is lagging the pack. But if we zero in on the last month to see where the money flows have been going, you can see materials have certainly picked up very significantly. But information technology, small caps and finance still looking pretty good. So that's the way markets are sitting at the moment at the index level. The Australian dollar fractionally lower at 62.1. Our market ended up down 0.25% for the week. But again, we've got some very expensive growth stocks that have delivered. They've either delivered through earnings announcements, or they've delivered through new contract wins, or whatever it might be. But these seemingly super expensive growth stocks that can't be justified, the price can't be justified on the basis of the normal sort of fundamental analysis, they keep rising, and they keep rising quite strongly. So there's a heck of a message there about where one makes money in the market. And if it was based on fundamentals and valuation, then you probably wouldn't own these stocks. But there are other factors at play here that are equally important. So we had several already expensive tech stocks that set new highs, but what we are seeing is some valuation volatility on the point of release. And if you look at REA Group as one example, the stock price initially went down, but then within an hour or so, it had gone into the positive and finished quite positively, and then went on with it for the next day or so. So we're seeing plenty of valuation volatility, and to me that just says there's plenty of nervous sellers that are ready to hit the sell button. So I'll just check in on the currencies. So the US dollar, this is on a weekly chart, so you can see a lot of volatility. It's a big range for the week, but net didn't end up doing anything. And the Australian dollar also ended up slightly higher, US dollar slightly lower, and it's just hanging on to this important support level around 61. If we look at the ASX 200, you can see there was plenty of downside during the week at the index level, but finished up just very, very fractionally lower. Now let's look at precious metals while we're here. This is silver on a weekly chart. So we're starting to pick up in the short term. Silver is forming higher highs and higher lows. It's not looking nearly as good as gold is. And that could be the opportunity with silver. But it's certainly been lagging for some time, but it's heading in the right direction. All the moving averages are all pointing upwards. They're all lined up in the right order. The price is now above even the short-term moving averages. So there's no question that silver is trending upwards and is a pretty good potential opportunity. This is gold in US dollars, weekly chart. So you can see an excellent week. We broke out a couple of weeks ago. It closed at 28.59. In Australian dollars, also continues to surge, and we closed the week at 45.57, having hit 46.50 during the week. So this is a massive rise for gold. Gold stocks in Australia have done pretty well, and they've certainly done better than many of their global peers. That's GDXJ. So you can see that this is nowhere near as exciting as the gold chart. I'll just confirm that data with precious metals. So gold up $62, and we've covered off those other prices. Now, there's some really interesting and perplexing dynamics around the gold market. It's really very unpredictable. So I wouldn't be putting your house on the gold market at this point in time if you're not already in there. Yes, there are numerous strong tailwinds around all the risks that are out there. The risks around tariffs, around trade wars, around geopolitical events, just around the uncertainty of Trump. And those tailwinds will probably remain to a degree. but there are also lots of things that could head in the other direction. The price of gold has a strong relationship with real rates of interest, and it's unpredictable what the Fed may do. We're also seeing central banks diversifying their exposure to US Treasuries by buying gold. And in London, we've seen of late there's actually been a physical shortage extending to multiple weeks of being able to access physical gold. And it's not what it seems on the surface. The natural reaction to that might be that there's just so much incredible demand for gold that that's why the price is going up. And that is partly true. But it's also true that this is a preemptive move to protect the US futures market, because the futures may require to be settled in physical gold. And so gold has been moving from London to New York physically to facilitate that settlement process. And this could easily and very rapidly be unwound if talks between Trump and China go well on trade. Then some of the fear that's causing that movement to New York could unwind very, very quickly. So the message is, don't think that just because we've got all this uncertainty that it's a given that gold is going to keep rising. It might, but there are some very complex dynamics here that could turn around and bite very savagely. Central bank demand exceeded 1,000 tonnes in 2024. I think that was the second year in a row, and everything is looking like calendar year 25 could do something quite similar. So on balance, there are reasons why the gold price could continue to the upside. But just be aware that part of why it's done what it's done recently could reverse very, very quickly. It's not a stable situation. Turning now to other commodities, copper had a very good week, up to $4.59. Nickel also rose up to $7.03. Copper is up 8% since January 27, and also up 14% year to date. So that's been a very strong move in copper. And part of that is that there's been a slump in export volume by Chile, not necessarily in dollar value, but certainly in volume. And so that has got the market concerned that there could be some supply issues. And there is also some market expectation that demand may increase unexpectedly. So again, these are assumptions that may or may not come to pass. But for now, the copper price has had a pretty good period. West Texas Intermediate crude eased again a little bit, and the oil market is one that's always unpredictable. But it's that unpredictability now with the geopolitics and with Trump. It's too hard for me, frankly. It's too unpredictable. I deal in probabilities. And when I have a market that is highly unpredictable, I just leave it alone and go somewhere else. There's the spot copper chart. You can see we've come up very, very quickly from $4 at the start of the year, and it's been a particularly good finish. So wrapping it all up, I think the most certain aspect of 2025 is going to be the uncertainty. And therefore, locking in a view about how things will be is an incredibly dangerous thing to do. You need a plan that's built around the most highly probable growth stocks that one can find. So that's step one. So we're using fundamentals to get us into the right ballpark, and that improves our chances of success. Adding a bit of sector spread within that can help protect portfolios, but only within the highly probable growth sectors. Never add sector spread or diversity for the sake of it. Only do so within the most highly probable growth areas. And then thirdly, use chart patterns to advantage. Learn to read the play or align yourself with someone who can read the play well because they've got the experience to do it. Portfolio analysts upcoming this week is just that. It's reading money flows through chart patterns. And the more that you can build that skill, even if you still rely on other sources long term to read the play, the more that you understand, the more confident you will become and the better you will execute. So gaining some education and some knowledge and experience is still very vital. So that's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.